What's going on, guys? Resilient Trading Group here, coming at you with another video. In today's video we're going to be going over what is a return on investment, more commonly known as ROI, and we're going to be breaking it down for you into different segments. So segment 1, we will be going over the return on investments with different banks, and this is through bonds and cash ISAs, which is here. The second ROI would be with stocks and a return on investments with investing in stocks, individual stocks, and then your S&P 500, your FTSE 500s, etc. Then your third type of return on investments would be with foreign exchange, more commonly known as FX, and this would be hedging your bets, either buying or selling a currency pair. Last but not least would be the alternative kind of investments, which is your personal one, which would be with Rolexes and supercars, and that would be your passion kind of investment because it's what you'd like to collect and it's a collectibles item and they hold their value over a long period of time, etc, etc. So before we head into the video, make sure you hit the subscribe button if you haven't already, and make sure you hit the like button down below. So jumping into the video, what is return on investment, ROI? The return of investment is a ratio between the net profit and cost of investments. A high IRL means that investments gains compare favourably to its cost. As a performance measure, ROI is used to evaluate the efficiency of an investment or to compare the efficiencies of several different investments. So you'd be able to see what you first started off with is either £500 in an investment, and then it ends up with £1,000. That is your return on investment. It's more favourably in your favour by 100% because you've made 100% gains on it. You started with 500, now you got 500, you've doubled your money. So let's jump into it. Now we know what return on investment means. We're going to be starting off with banks. Now with banks, there's savings accounts, it's mainly low interest rates, and it's bonds, and it is no risk at all because it's mainly fixed. Now if we look at this is just on a price comparison website. As you can see, you're going to get a fixed interest rate of 1%, minimum 10 to 250,000. 1% is absolutely nothing. With a bank, you're not going to get more than 1.5%. If we jump to a fixed rate, what you'll now see is that this is a 5-year fixed cash rate ISA, meaning you can't touch your money for 5 years, you can't take any out, you can only put money in, and it is fixed at 1.4%. So no matter what, this is so low, it's incredibly low, and most people now stick as far as they can from banks just because of how incredibly low it is. And this is also for bonds as well. Bonds are different to cash ISAs, but not too far different. They're about 0.1% more favourable. Here's a bond, it's 1.1% fixed, and that's for 5 years. As you can see, bonds and banks, people know to stay away from them now because your money, it's safe, there's no risk, but at the end of the day, you're not making any money at all. Now if we move into stocks, as you can already see at the bottom left of my screen, the 1 year return is 14.4%. That is 14 times more than what you was getting with a bank in 1 year. The bank was offering you 1.5% over 5 years fixed. You can't take your money out. With the SPX 500, which is a stock, and it's the biggest stock in America, it's got the biggest 500 companies in America, and last year in 2019, a 1 year return you got back on your money was 14%. Already 10 times better, 14 times better than what you was getting. There's minimum risk. If you know what you're doing, there's minimum risk when investing with the SPX 500 and the indices and the FTSE 500s and 100s. Minimum risk, and they always have high percentage returns. Most FTSE 500s are about 10%, and most SPX 500s and FTSE 500s, they have a 1 year return of 14.04%, which is incredible. You're already beating the bank. Literally, it's there, it's plain and simple, it's easy to understand, and this is what people are now starting to understand, that you should be putting your money into stocks for a long period of time and just holding your money there, because all it will do is gradually grow, and your account and your portfolio is gradually going to get bigger with it. So we just looked at doing big company stocks such as the FTSE 500s, the S&P 500, etc. Now if we move over to individual stocks, which are way more high risk, but again, you're only going to be doing 5% risk of your overall portfolio, of your overall money. You're only going to be risking 5% on an individual stock. So the Tesla, which is one of our favorites here, as you can see, it has gradually grown, it's gradually gone up. Here we have a box of consolidation starting at 375 and the top of it being 443, which it currently just broke out of on 16th of November. It broke out at 441 and it shot straight up to the last resistance and the last high at 500. Now these are individual stocks. These are ones you're going to have to research more, ones you're going to have to take time with. You're going to have to do a lot of background research before actually investing your 5% into an individual stock. But now we move over to foreign exchange, the FX markets. Now there's only two ways to make money when investing in FX, and that is either buying or selling. Now remember, pigs always get slaughtered. You can never be too aggressive when investing in absolutely anything. Putting all your money into one investment will never work out. You need to have a diverse portfolio and invest in different places such as stocks, banks, and then FX, and then do your watches. You shouldn't put your money all into FX or all into stocks. You really need to broaden and really diversify what you're actually investing and where you're putting your money. So FX, very simple, very easy, is buying or selling. If you think the pound's going to go up, great, then buy it. If you think the pound's going to drop, great, sell it. There's multiple reasons for buying or selling an FX. There is your technical analysis, which is very easy. It's your support and resistance. It's your boxes of consolidation. It's your Fibonacci, etc. What we would wait for here is a breakout. If it breaks out to the downside, we would then select to the next level of support here. If it was to break out on the upside, we'd look to buy it to there. And that's how you make money in FX. There's different ways. There's swing trading, scalping, or a day trader. Scalping is getting down into the small nitty gritty minutes where you're just doing these small, you're in and out of the market within a couple minutes. And that works for some people. It's about your personality. Are you like that? Day trading is on the 4-hour and daily time frame where you're just looking to be in it for about a day or two. Now swing trading is predicting long time frame movements such as this. If you was to trade this, what you'd be doing is drawing a channel like this, and what you'd be looking at really is that you honestly think the CAD yen over the next few weeks is going to break out of this line of the bears, and it's now just going to be very bullish and just sell. It's going to buy, and going to jump straight back up. You've got this line of support 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times. It's hit support 10 times on this bottom channel trend line. What you're going to do is you're going to buy it for several weeks until it makes a new high up there, and you're looking at a movement of around 2,000 pips. If you're doing a pound to pip, that's £2,000. So that's how you invest in foreign exchange. You're buying or selling a currency pair in whatever way you think it will go. If it goes against you, then you lose money. Now the alternative type of investment is with your personal passion ones. Now if you're into cars, then you'd buy a Jaguar or you'd buy a nice old school classical car. But if you like your watches, then you'd be buying a Rolex. Now if we look at the Rolex, and they're all here, all the different types of Rolexes, the models, and from when they first founded and where they are to currently. So for example, if we just start with the Explorer number 1, 1970, worth $210, still a very nice watch, quite expensive, especially back in that day. Money was worth a lot more back then. But if we go across, it's 2008, they don't make them anymore, discontinued, 5,000, and it continued to grow. They now have the Air King, the Explorer 2, Explorer 2 started off in September 2010, started off at 5,725 and now worth 6,550. It's held its value for the last 3 years and continuing to gain. Now, if we just look at this last comment, as you can see, Rolexes have only ever gone up in price. For example, the steel and gold Datejust TT. Back in January 2020, only a few months ago, 6 months ago, near enough $11,000. Now, September, 4 months later, 5 months later, $13,000. These are personal passions though. If you like watches, you're a collectible, and you're someone who likes to look after things, and it's a watch, then by all means, buy one, you know? If you've already got investments in stocks, FX, you already have a few bonds, then why not just diversify, broaden your horizons, and start to look at watches and what other things are going to be able to hold their value and go up in time. Ultimately, all we're trying to do is get the most out of our money. We're trying to make money work for us, and the only way we can do that is by having a high return on investment. And the way of getting the best return on investment and the highest return of investment is by diversifying your portfolio, being in as many things as you can, and only having a maximum of 5% of your overall cash balance in each stock or each watch or each FX trade. Make sure there's only a maximum of 5%, and you're broadening your horizons. You're getting into different SPX 500s. You're looking at different stocks. You're looking at pharmaceutical brands. You're looking into science. You're looking at automobiles, Tesla, Neo, etc. But all we're trying to do is maximize our return on investments by doing as many different types of investments. And the SPX 500 for me seals the deal on stocks, because the 1 year return at 14%, you cannot argue. Guys, if you have liked today's video, then please smash the like button down below. Make sure to subscribe if you are new around here, and I hope to see you in the next video.